Right. Good afternoon, everyone. We'll do some questions related to Incoterms. Then I'll touch a URC past paper question and Forex one. And after that, we'll shift to the new session that we started last time, revolving facilities. I'll straight away hit a sum. And so first, take the Incoterms assignment that I have given to you. And question number 2. In the Incoterm assignment, question number 2. Starting with Sri Lanka exporter Kerry Limited wishes to that question. Right. Just have a read on that question. Right. This is how the question goes. A Sri Lanka exporter, Kerry Limited, wishes to export shoes to Germany, and the shipment is to be made from the port of Colombo to Hamburg. And the buyer wants the exporter to arrange and pay the sea freight. Identify the trade terms as per Incoterms Rules 2010. From the answer above A, state the trade term which has lowest cost to the Chinese obligations. If the trade term used was CFR Hamburg in Incoterms 2010, and the goods are damaged during the loading of the goods to the vessel at the port of Colombo, state who will have to bear the risk and how they could recoup their loss. Recoup means mitigate the loss. Right. The Sri Lankan exporter, Kerry Limited. Now, exporter is in Sri Lanka now, right? Exporter is in Sri Lanka, which is to export shoes to Germany. And the shipment is to be made from Colombo port to Hamburg. Right. Now, the people who know a little bit of geography will know Hamburg is a landlocked place. But however, there's a port there. It's a river port, not a sea port, right? So when you say port to Colombo to Hamburg, you have to take an implied situation where port of Colombo to port of Hamburg, right? And the buyer wants the exporter to arrange and pay the sea freight. Right. So seller has to contract for the sea freight. So obviously, it has to be either CIF or CFR, right? CIF or CFR. Right. By this time, you should have had gone through the A3 of all the Incoterms. And if you go through carefully, A3 in CFR and CIF, in both Incoterms, you have to, the seller has to contract for carriage. There are some more other Incoterms also where the seller is concerned, have to contract for carriage. Is the CIP, CPT, then all D group ones, seller has to cover. Then why I chose only the what you call this CFR and CIF fees out of those many Incoterms, because seller has to arrange for sea freight. So CIF, CFR, FAS and FOB, those 4 Incoterms could be used exclusively for sea and inland waterways. So you can eliminate the FAS and FOB, that is free alongside ship and the free on board the trade terms, because in both trade terms, you go through carefully the A3, make a reference in there. Seller need not contract for carriage in both FOB and FAS. He is not worried about the carriage. In FAS, he will keep the goods alongside the ship. Alongside the ship means beside the ship, nominated by the buyer. In other words, the buyer will nominate what the ship is. And the seller's responsibility is to go and keep the goods beside the ship or alongside the ship. Then the delivery completes. In case of a FOB, he has to take a step further. He has to take the goods not alongside but on board the vessel. That vessel be nominated by the buyer again in case of FOB. So those who are the goods being placed on board the vessel, which is named, then the delivery completes. In other words, risk passes on to seller. Right? So there's no carriage involved there. And the seller goes off. But in case of CIFL, CFR, they have to contract for carriage up to the port of destination. In case of CIP and CPT, the seller has to contract for carriage up to the place of destination, not to the port of destination, but to the place of destination. He can't just, his contract will not be over once the goods be reached to Colombo port, but he has to go further from Colombo port to a landlocked place called Kalani or Wattala, wherever, anywhere. Right? But in the case of D terms, seller has to contract for carriage, whether it's what you call DEP or DDP. In the new version, it's DPU and DEP and DDP. So all these D terms, seller has to contract for carriage. And since it's a port-to-port shipment, you cannot take the D term. You have to take only the CFR and CIF. So identify the trade terms as per Incoterms 2010. So you say CFR and CIF will not get marks much, but you have to say why you are not taking the other two Incoterms, that is FAS and FOB. Right. From the answer above, state the trade term which has lowest cost to the Kenny's obligation. So when you say CFR, there are responsibilities leveled upon the seller. That is, from A1 to A10 will denote what the seller's obligations are. Likewise, in CIF also, there are responsibilities additional to CFR. It is the same responsibilities where the CFR and CIF concerned, but additionally, the seller has to contract for insurance in case of CIF. That's why the CIF value is higher for the same consignment as opposed to the CFR value. So, from the answer above, state the trade term which has the lowest cost to the Kenny's obligation is the CFR. Right. Right. Please note there's another handout in the uploaded to you. That is in case of facilities, revolving facilities. I have sent 3 assignments. I think only 2 have been loaded, not been rectified, right? Please note of it. There are 3 assignments, 1, 2, 3. Right. Coming back to the question, B, from the answer above, state the trade term which has the lowest cost to the Kenny's obligation, CFR, and you have to give a little bit of an explanation why the CFR is less than the CIF. In CFR, seller do not obligated to contract for insurance as opposed to CIF. Right. If the trade term, this is a good question. If the trade term used was CFR Hamburg, Incoterms 2010, and the goods are damaged during the loading of the goods to the vessel at the port of Colombo, state who will have to bear the risk and how they recoup their loss. Right? Now the goods are coming from Colombo to Hamburg, and since goods are exporting from Colombo under CFR, you have to state CFR Hamburg, right? CFR Hamburg. And here there's a scenario where the goods are damaged during the loading of the goods to the vessel. Right? Loading of the goods to the vessel. So if something happens while loading to the good, loading the goods to the vessel, then it's the responsibility of the seller. It's the responsibility of the seller. But once the goods being placed on board the vessel, and if the goods being damaged due to high tidal waves or some kind of a circumstance, then it's on the buyer's responsibility. That the responsible part. But here they are asking who could recoup their loss. Right. Now, if you go through carefully the A3 and B3, A3 and B3, B for Bertie, A3 and B3 of the relevant Incoterm CFR, you will notice under contract of insurance comes under A3, under contract of insurance, both seller and buyer are not responsible to each other. Right? If you go to A3, that is A3B, A3B, you get the contract of insurance, and it will say no obligation. And if you go to the B3, it will say no obligation. What is A3? Seller's obligation towards buyer. And B3 means buyer's obligation towards seller. So neither party are responsible to contract for insurance in case of CFR. Right. So we'll start with the answer now. Take it down. The trade term CFR, cost of freight. The trade term CFR warrants neither party, warrants, WARRANTS, warrants neither party. Neither party means buyer and or seller, right? Buyer or seller. Neither party, that is buyer or seller, responsible to contract for insurance. Next point. If the goods being damaged, during loading to the vessel, the risk is on the seller. But if the goods being damaged after placing the goods on board the vessel, after, underline the word after there, then the risk on the buyer's account. Then the risk on the buyer's account. Next point. Even though buyer is not responsible to contract for insurance, even though buyer is not responsible for contract of insurance, buyer's bank should have advised the buyer to insure the goods at least from port to port. To recoup, you can use the word mitigate, to recoup such unforeseen losses. Right. Now take the URC assignment that I have given to you. That is the past paper. I have given 2 assignments now. So this is the past paper question. URC 520 assignment 2 past paper. And question number 6. Starting with modern garments. Right. I'll read out the question. Modern Garments Limited, a manufacturer, export of garments in Sri Lanka, has signed a sale contract of children garments with a buyer in Germany. The agreement calls for 60 days credit facility. This is the March 17 paper. The agreement calls for 60 days credit facility under DA terms of documentary collection. The value of goods is euro 50,000 and the delivery terms is here. Thank you. Right. Thank you. Sorry about it. The agreement calls for 6 days credit facility under DA terms of documentary collection. The value of goods is euro 50,000 and the delivery terms is CIF Hamburg Incoterms 2010. The payment term is 60 days from the date of onboard stamp. The place of business and the bank of the buyer is at Hamburg. Assume that the shipment date is April 1st and the exportee is also planning to get financing against this export by discounting the bill. Answer the following questions. What are the documents that should be produced to the bank in order to receive the payment from the importer? Now, this is a practical question actually. You don't find any of the articles stating in the URC what documents needed to transact, right? In the initial stages in the course, I did say there are vital documents that you need to see that the trade is moving forward. So those are the documents that you needed for collection bill source as well. Why? This is because of a trade transaction, right? So what are the documents, if that the case, should be produced to the bank in order to receive the payment from the importer? That goes without saying, buyer needs certain documents so that he will be able to clear the consignment. No point getting all the unnecessary documents where he won't be able to collect the consignment, clear the cargo. So the seller should make a note of it and communicate with the buyer and ask the buyer what are the documents needed for him to clear the consignment without any hindrance. Then he will get the payment. Right. So take it down. Shipped on board bill of lading. Shipped on board bill of lading. That's the title of document, right? Shipped on board bill of lading. You need that document. You means the buyer need that document, right? Shipped on board. Remember, shipped on board. Now, get the spellings right. Is a verb. SHIPPED. Shipped on board, not ship on board. Shipped on board. Because it is not a mere receipt for shipment bill of lading that the banks need. Banks need a bill of lading evidencing the goods being shipped. Right? That is what you call a shipped on board bill of lading. There are various kinds of bills of lading, receipt for shipment, shipped on board like that. But we need a shipped on board bill of lading. Right? Shipped on board bill of lading. And what else? We need a commercial invoice. Not a pro forma invoice, but a commercial invoice. It's a legally binding document, which is the final invoice drawn by the seller to the buyer based on the pro forma invoice, right? So commercial invoice. Then the packing list. Packing list. Packing list. And remember, the question says delivery terms is CIF Hamburg, CIF Hamburg. Then the buyer needs an insurance policy or a certificate, right? So don't miss this. So say insurance policy or a certificate of insurance. Insurance policy or a certificate of insurance. Right. And a certificate of origin. Certificate of origin. Certificate of origin. Right. And again, the question says, the agreement calls for 6 days credit facility. That's the third sentence. The agreement calls for 60 days credit facility. That means the surprise credit is given in the particular transaction, which is under the A documented collection. Documents against acceptance. So if it is a documents against acceptance, buyer surely need a bill of exchange issued by the principal. Principal is the Sri Lankan exporter. Otherwise, he won't be able to accept the bill of exchange. Right. So bill of exchange. So those are the most vital documents according to this question. And also you say be on the safe side, any other document required by the importer. Any other document required by the importer. Right? We did a ship on board bill of lading, we did a commercial invoice, we did a packing list, and we did an insurance policy or certificate. Then we did a certificate of origin, the bill of exchange. We means the buyer in Germany. Bill of exchange or any other document required by the importer. Right. What type of bill of exchange should be issued for financing against the bill, and when it can be considered uh, for discounting? No, I missed the second question. No, right. Briefly explain the risk involving the transaction for the exporter and the importer. Sorry. Briefly explain the risk involving this transaction for the exporter and the importer. Right. Take it down. Exporter. If the buyer, while taking down, you can understand the answer, right? Uh, if the buyer goes bankrupt, now the buyer has already collected the document by accepting, and he has cleared the cargo, and the seller has to wait, wait because until the 60 days lapse, because its tenor is 60 days, so that the buyer will pay. So what happens before the due date if the buyer bankrupts? Then it's a risk, right? Right. If the buyer goes bankrupt before the due date, before the due date, before the due date, the payment will be put at risk. The payment will be put at risk. Put at risk. That's what I call jeopardized. Jeopardized. So within brackets you say jeopardized. JEO PAR DI is a DD. JEO PAR DI is a DD. That's a common thing that the seller can anticipate, right? Because the buyer has enjoyed the goods, he has cleared the consignment also, and the seller has given the 60 days credit, and before the 60 days, genuinely buyer goes down, buyer goes for liquidation, bankrupt. And what happened now? This was very common. Buyer will not, by all of a sudden, buyer will back out of collecting the document. When the collection documents come to the bank, bank will always notify the buyer saying that here, look, the documents have come, please come over in person to exit the bill of exchange and then collect the documents and go. That's the normal notification the buyer, the importer's bank will send to the customer, impliedly means over the phone or by writing. But the buyer doesn't show up, right? Then the payment will be at risk. Not only the payment, even the goods are at risk now, right? So take it down that point also. If the buyer backs out of the deal, or refuse to accept the bill of exchange, or refuse to accept the bill of exchange. We can think of another risk also. Until the goods are collected on voyage, there could be stoppages. You call it transit. So transit is on exporter's account anyway, because the goods have not reached to the buyer's country. It's on a pit stop, right? So take it down that, because that's also risk, right? So until the goods are collected, transit risk, transit risk. Transit risk is on exporter's account. Right? So what are the what could be the risk that you can think of in case of a DA collection? Before the due date, buyer could go down, or buyer will not show up, or refuse to accept the bill of exchange. Why he's refused to accept the bill of exchange? I have this personal experience also. Once you accept the bill of exchange, you are statutorily obligated to pay. You can take it to courts if you do not oblige. So, because you get heavily fined and blacklisted also if you don't pay on the due date after accepting the bill of exchange. So some buyers, they refuse to accept. Right. And the other risk you think of is just imaginary risk that I was saying. Because depending on the journey, if it's a lengthy journey, obviously there will be the goods will be unloaded and reloaded to another vessel, to a connecting vessel. That's what we call transit, right? So it will be unloaded and reloaded to another vessel, and the second leg, that vessel will move towards the destination. So there could be handling errors, damage of goods, a kind of thing. Buyer doesn't have anything to do with it. It's a seller's risk. Seller's risk, right? Something like that. If you import a vehicle, the vehicle will come and land in Hambantota. So until the vehicle comes from Hambantota to Colombo, that's a risk. That's a risk. It's not the buyer's risk. It's the seller's risk. Right. Then the next. Then the importer risk. Right. So say importer. Earlier the exporter, the importer. Say unless the certificate of inspection is accompanied. Certificate of inspection accompanied the documents. Importer cannot inspect. Importer cannot inspect or sample the goods. Right? That is obvious. Then that is kind of milk food, lubricants, those sensitive items. You need to have a on-board or an on-deck inspection. For that, you need to have an inspection certificate. So if they won't accompany the inspection certificate, the importer will have a risk of clearing the cargo from the customs. Because there are local government authorities also, if you get down certain goods, not all goods, certain goods, you need to have certain classified documents. They are called inspection certificates, right? In case of milk food that I took as an example, you have to have that document called the Load Port Survey Report. What is that? It's an inspection certificate. Load Port Survey Report means at the port of loading, the goods has to be inspected by the buyer's agent. Right. If the payment is not made as agreed, now importer study for himself, that's the risk, right? If the payment is not made as agreed, the exporter can initiate legal proceedings against the importer. That's other risk too. That's my risk, right? I have ordered the goods to come and promising that I will pay. So if I won't be able to pay, right? Not that I am cunning or trying to evade. If you don't have the capacity of paying for some reason, because of this pandemic affair, or because of some frustration that I am unable to pay, I face a risk that my seller will initiate legal proceeding towards me, right? That's a risk for my image, for my reputation, for my business, and towards my central bank, right? Then third risk, defective defective documents by the exporter may cause delay in release of goods from customs. Now, I wanted a particular document, a particular quality certificate in the manner that I have shown to the seller. Why is that? Not because of my personal requirement. That is the requirement by the country of importation. My country, my custom, my local government authority says this is the document that the seller has to produce from a competent authority. So I have told the seller, when preparing documents, you make sure that you get this particular document from so and so, that is the competent authority will mention. And he has sent the document all right, but not with that particular competent authority. Somebody else. That somebody else's authority is not recognized by the customs in the import. So there is a delay of communication, because the customs will not allow me to clear the consignment because of that lapse by my own customer, the seller. So I have informed him, here, look, the document what you have sent me is a useless thing. Why don't you courier? So he will need to oblige to send the proper document. Because that delay might eat the supplier's credit of mine, because he has given 60 days. Because of this communication gap, another 7 or 80 days will consume. So it's a risk in part of the importer, right? So that's the defective documents may cause delay in release of goods by the customs, thus affecting no, not thus affecting, strike that word, thus effectively reduce the credit period for sale of goods. Right. What type of bill of exchange should be issued for financing against the bill, and when it can be considered for discounting? What type of bill of exchange? Right? This under system uses bill of exchange, right? You can't have a side bill of exchange in case of a tenor transaction. The 6 days DA means you have to have a user. There are only 2 types of bills of exchange, right? A side bill of exchange or a user's bill of exchange, right? So you say, apart from shipping documents, for a bill of exchange, you don't call that as a shipping documents, right? It is a financial document, right? Apart from shipping documents, an user's draft, get the spellings right, USANCE. An user's draft means a bill of exchange. An user's draft should be drawn and user's draft should be drawn. Demanding payment. Demanding payment. "60 days from the date of receipt of the document." 60 days from the, not for the date of receipt of the document. I did a mistake here. We read the question again. The last sentence, it says the payment term is 6 days from the date of onboard stamp. Onboard stamp means from the date of shipment, right? So you have to demand the payment from date of shipment, in other words. So you say, apart from shipping documents, and user's bill of exchange or a draft should be drawn demanding payment 60 days from the date of shipment. From the date of shipment. So onboard stamp means that. Onboard stamp means, bill of lading. Usually, bill of lading in nature should have a document or what you call a date of issuance. The issuance date has to be there in a bill of lading, right? Any transport document should have a date of issue. Not only the transport document, declarations, insurance policies, bill of exchange, certificate should bear a date. So bill of lading is a transport document. In nature, there should be a date of issue. But the date of issue of the bill of lading is not necessarily mean that the goods have been dispatched from the port of loading. So the bank will not accept a bill of lading, a mere receipt for shipment bill of lading. A receipt for shipment bill of lading also will carry a date of issue. But the bankers will not recognize that as a proper title of document. So therefore, what happens? Either shipper has to arrange a shipped on board bill of lading, which is pre-printed, or if it is a receipt for shipment bill of lading, a further impose of a what you call imposition of the stamp needed saying on board, and the date has to be there. So on board date is the date will be considered by the bank as the date of shipment. Right? Sometimes the on-board date and the date of issue is the same. That doesn't matter. It could be a prior date or a post date. Still, it doesn't matter. But bank wants the on-board date. On-board date. Unless otherwise, it's a shipped on-board bill of lading. Right. So the payment has to be demanded from the date of shipment. Right. So the question says, what type of bill of lading should be issued? Fine. For financing against the bill, and when it can be considered for discounting. Discounting, you always discount something before maturity. If you wait until the maturity, the question of discounting will not come. The customer brings the $100 bill. If I am willing to discount, I will give you 99 cents, $99. So $1 will be my discounting fee. But if he waits until the maturity, there's nothing called discounting, so I will $100, right? Right. So you say financing against bill, can be considered. Finance against bill can be considered financing against bill can be considered only after importer, that is the buyer, importer has accepted the bill of exchange and confirmation to that effect, I'll explain that. Confirmation to that effect it received by the is received by the received by the remitting bank. By the remitting bank. Right? Usually, when the draft is given by the importer's bank, that is from the presenting bank to the drawee to accept. Once the drawee accept the bill of exchange, listen carefully. Once the drawee accept the bill of exchange, the presenting bank will retain the bill of exchange, which is accepted by the drawee, and release the rest of the shipping documents for him to clear the cargo. And simultaneously, the bank will, via SWIFT, send a SWIFT to the sender, that is to the remitting bank, very mostly remitting bank, saying that the draft been accepted by the drawee for payment and give the due date. By sending the, what you call that SWIFT message, that short message is an authenticated SWIFT, the presenting bank will have no obligation to pay at maturity. It just conveys to the remitting bank that the drawee or the buyer has accepted the bill of exchange. After that, if they want to discount, that is their baby. On the other side of the coin is, remitting bank will not discount just because the customer says to discount, unless the importer's bank, which is the importer's bank is the presenting bank, sends a confirmation saying that drawee has accepted the bill of exchange. That's what I said. Financing can be arranged once the importer has accepted the bill, but the seller's bank will not know that the importer has accepted the bill. No? So the confirmation for that effect has to receive from the remitting bank. So that's what I said. Right. 4. If the documents arrive in the before going to that question, so 1, 2, 3, I need to have a little bit of feedback from you, just a yes, no answer. Just give me a feedback like good souls, whether you understood or not up to 1, 2, 3, and just say yes or no or halfway or whatever it is before going to the 4th one. Quick. Right, thank you very much, Pradeep. Right, we'll move to question number 4. Yes, thank you once again. That is Chamila Mutugala. If the documents arrive in Germany 5 days after the loading and acceptance is given 3 days later. No, I didn't catch. We'll read again. If the documents arrive in Germany 5 days after the loading and acceptance given 3 days later, exchange rate is given as 157.40 per euro. Calculate the amount of money the exporter might get at bill discounting and how long the financing would be available to the exporter. Right, to answer this question, you have to work in the export division, right? Right. Now this modern garment, that is Sri Lankan customer exporter, sending tea to a German buyer. No, not tea, a children's garment to buy in Germany. Right. So when he sends the children's garment, he has to send the documents also as well. Right? The documents arrive in Germany 5 days after the loading. So when is the loading date? Shipment date is April 1. It's the question it says, right? Assume that the shipment date is April 1. So 5 days after, only the what you call the documents arrive in Germany. And acceptance is given 3 days later. So once the documents are received, the German bank would have informed the customer, here, look, the documents have come, please come over in person to accept the bill of it. So 3 days later only, he has accepted. In other words, 8 days being taken off from where? From the supplier's credit. That's the part you should understand. You needn't work in the trade department for that. If you just use common sense. Now, Colombo guy has given 60 days credit to the German guy. He's the supplier. Colombo man is the modern garment is supplier. So he has said, all right, you are a good customer of mine. You need time to sell the products because it is not fast moving, chillers garments. So I will give you 2 months the credit period. So documents arrive Germany 5 days after shipment date. And remember, due date is calculated from the shipment date, not from the date of receipt of the documents from the German counter. It's for the shipment date. So shipment date is 1, and the documents have gone to Germany 3 days after shipment date, or rather 5 days after shipment date. And those whose document be received by the German bank, their customer has come over there to counters 3 days after that. So 8 days been taken. From 60 days, 8 days been consumed, in other words. And when he comes to the bank and requests the bank to give a discount for 60 days, bank will say, no, I can't discount it for 60 days. No, I will discount it for 52 days. That is understood. No? If that is part, if you have understood, just say yes to me, then I'm comfortable. Otherwise, I have to put down myself and go slowly once again. Just make a quick yes or no. Pradeep, are you working for export? So I get some frank answers also. I like that. Now here, look, child. Padmanabhan Pradeep, you are in imports. So no wonder you can gather this, huh? Right. Where was I? Right. Now here, listen carefully. If the documents arrive in Germany 5 days after the loading, underline the word loading there. Loading means shipment date. Due date is calculated from the shipment date. That's in the sum. 6 days from the shipment date. Right? But the documents goes to the German bank 5 days after shipment date. Right? So 5 days after shipment date means buyer will not use the full, buyer won't be able to use the full credit period of 6 days now because 5 days already gone. And the buyer also comes to the bank 3 days after that also. So 8 days have gone from the credit period. It's 52 days now. So it's not reasonable or fair by the German bank if the customer says, now you discount for 6 days. Actually, he doesn't have 6 days. He has only 52 days. Right. So I put it a different way now. Now again, I hope that won't be a no. Just say yes or no again. I'll simplify further. Very good, Gerald. And somebody else also said no. I want that person also say yes. Right. Thank you. So now you understood the 52 days. That's the only catch in this question. I don't know why, for a reason, this particular question being put. Don't blame me. I didn't put this question. Right. And this is a practical question. You don't have a support from the URC 522 for this question. It's a practical question, but a little bit of thinking involved here. You don't have the 6 days credit period. You means the buyer. I'm telling the German buyer now. Right. With that little bit of a, what do you call that knowledge, we'll structure the answer. Due date. The due date for payment is May 31. That is 60 days from April 1st, right? You calculate as is May 31. April has 30 days, May has 31 days. So at May you have 29 days left because April 1 is the shipment date, 29 days. then again it will be 31 days to have balance the 60 days, right? So the due date for payment is May 31 and total of 8 days. Now you know how the 8 days have come, right? Total of 8 days were consumed. Total of 8 days were consumed. Before confirmation, was received. So the financing would be available for a maximum of 52 days only. For a maximum of 52 days only. So the value of the document is 50,000 euros. And the exchange rate is given 157.40 per euro. So you have to assume that is understood, right? You have to assume that is the 60-day rate. 60-day rate. Right. 157.40. Is the 60-day rate. Right? And you have to multiply this by 52. This is the 60-day rate, and you have to multiply by the 52, by 52. So this will be the discounting. If it is 100%, bank will give 50,000 euros to the customer. And if you are discounting, bank will apply 157.40. This is the 60 rate. But since there are only 52 days, bank will multiply by that by 52. Otherwise, it will be 157.40. Right? And when the bank discounts, there's a little bit of risk in the part of the discounting bank. What happens if the correction bounces back or some payment did not come? So there's a little bit of risk involved in the remitting bank, right? So for that service, and also this discounting, when you discount export bill, bank has to pay out of its own funds. The export proceeds haven't come as yet and hit the nostril yet. Bank using their own funds under reserve and credit the customer's account. Right? So this is an asset. And that means there's a interest involved in here. So you say less bank charges. Less bank charges. Right, understood? So now you need calculate and give the answer. You just show this how you calculate. Right. I wanted to do a forex sum also as well as planned, but then it took a little time to explain this URC question. So I'll postpone the forex sum to the next session, right? And today we'll start with the revolving facilities. That's on one solid 1 hour. We do the revolving facility. I don't know whether I can finish a question, a complete question, but we'll try. All right. So I have given 3 assignments. Third one came late. So take a print, the third one also for the next session. And today we'll tackle assignment number 1, question 1, Question number 2 is a very good sum, right? And for obvious reasons. And the question number 1 we'll discuss, right? And since I have given some answers, I've given all the answers in the forex sums. For two or three students, of course, give me a feedback and this do the sums and send to me. So others also attempt the sums in all assignments that I have given in the forex. Well, when you do check the answers, there are two good things happens. You become accurate, and also you develop the speed of assessment. Make sure and see whether you can, finish a sum within 25 minutes to 30 minutes time. 25 to 30 minutes time, right? That is the forex sum, right? So question number 1, rewarding facilities 1. So read the question. That is customer's name is Silva Limited. Silva Limited. Right. When you read this question, you will have the same feeling or the same reading of a forex question. In this revolving facilities also, you have the same two legs of the forex, the import leg and an export leg. In other words, to satisfy the export, one has to import some raw materials for a lesser amount and exclusively use that raw materials to satisfy the export. The same thing we did in the forex, and in the forex sum, we determine what is the amount that the customer as an exporter will receive after the lapse of a period. That's what we call the forward exchange contract period, the forward buying period, and what he will have to pay for the import bill, which is the forward exchange rate after specified period, which is booked after the date of contract. Now, here what we are discussing here is, before the payment received or will receive or have to pay, customer has to have a limit in place. Otherwise, you can't just, transact business with the customer. Customer has to have a limit. So we have to structure limit first, right? So we'll see how the limits are structured, and for that you need to have a little bit of a idea of the trade cycle, which I'm going to put in a timeline. I just started the timeline last time, so we'll do it in a comprehensive manner, and I will use some primitive methods also as well. You could just disregard once you get the hang of it. To make it easy, I will use that method. That is what they call the T account, which is very obsolete nowadays in accounting. Right. Now read the question with me. Your valid customer Sigma Limited has secured an export order to a buyer in Italy for the supply of goods of 128 tons by a single shipment to the value of 100,000 each month. So that is the export leg. In order to manufacture the required goods, that is the import leg. In order to manufacture the required goods, your customer will have to import raw materials from sold. They have contracted the supply and sold to purchase raw materials on users' terms, payable not just for the date of shipment. The LC for the import of raw material has to be issued 4 weeks before the shipment. It will take further 4 weeks to receive the goods and the documents. For each shipment, the raw materials required amount to euro 8,000. Each LC for import of raw material will cover the requirement for one export shipment. Right? Right. Now what I'm going to do is, I'm going to plot on the timeline what I have just read, which is in the import leg. right? So after I needn't look at the question over and over again, right? I will just plot the timeline while explaining, see whether you can catch up with the first site itself, right? This is my timeline against the transaction. LC is open, 90 days from shipment, that is a tenor. 90 days from the shipment is tenor, right? If you are slightly, if you are unable to catch quickly, refer to the sum parallelly, then you can see what I'm trying to do, right? And the value of the LC is 80,000 euro. 80,000 euro. And here you get the shipment date. Shipment date. So LC being open 4 weeks prior to the shipment date. It will take further 4 weeks to receive the goods and documents. So docs and goods will receive 4 weeks after the date of shipment. Right? Is it clear? 9 days from the shipment date, the LC will open 4 weeks prior to shipment date. Value of the LC is 80,000 euros, and it will take further 4 weeks to receive the documents and goods. So that means the import link I have plotted. Right? Understood? Give me a quick nudge whether you understood or not up to this level. At least 1 year, tell me. Yes. So I will take yes onto these things. That is, the board is clear. So what I am saying is clear, and the subject matter also understood. So all 3 ingredients should be included in that yes, right? Board has to be clear, my fonts has to be clear, and the timeline is understood. Right. Right? One more thing I need to tell you. If you want, you can, make a side note of it in here. Side note of it. That's for your knowledge. These docs and goods doesn't come in real life together. The documents and goods in real life will not come together at any time, right? It will come on separate intervals. But when we structure limits of a storyline for a customer, we always assume the docs and goods comes together. It doesn't come in real life, right? But if the customer says, given the customer will not know when the documents will come, so if you try to calculate on 2 different intervals, it's extremely difficult and cumbersome, right? And the other assumption is, you already know, that is 4 weeks equal to 1 month. 4 weeks equal to 1 month. So we have 2 assumptions now. 4 weeks equal to 1 month. Docs and goods will come together. Right. Now, that is the second paragraph that I read. Then the third paragraph, the clearing charge and custom duty, don't read. So I am omitting that. The next line is very important. So I am giving these hints for you to chase and find the important clauses when you get a sum like this. Otherwise, seeing the length of the question, you get scared. So don't read the clearing charges. But I'm not telling you to miss it. It's off the queue item, so we will read it separately. Right. The next paragraph is very important. Time taken to manufacture the goods and export them will be 4 months from the date of receipt of raw materials. That is, once the goods are received, the customer. Now here, like the forex sum, it is the exporter and the importer the same customer, right? That is, Silva is the exporter and he is the importer himself, right? So once the raw materials received, he will start to manufacture. To time taken to manufacture and keep the goods in an assembled form of export will take 4 months. That's what it says, right? 4 months. 4 months. So the export will take place. Right? So now goods are on voyage now. Goods are on voyage to the buyer's country. Now the seller or the exporter has the document, the shipping document. So he will give the document to his banker. Banker will purchase the documents, right? Or discount the document. Now we understood what discounting is. If it's a user's bill, bank will discount. Otherwise, it will purchase, right? So the bank will purchase the documents, right? Once the bank purchases the documents, bank will give the credit to the customer if there are no loans being given. Loans means what? Pre-shipment facilities or post-shipment facilities, right? Depending on the circumstances where the export is concerned, if he wants to make a credit loan beforehand, or since he's importing, he needs import loan. Those loans and the what you call the export loans and the import loans being liquidated by the export proceeds, and the balance left over will be given to the customer. So in real life, it doesn't happen, na? In real life, the time that the export is done, the export documents are not given to the branch or the bank. It will take some time. Here we make an assumption: the day or the time that the export is done, export bills are purchased. Export bills are purchased by the bank. EXBP, export bills purchase. Export bill purchase. Right. When you purchase the export bill, what the bank will do? Bank will send the bill to the issuing bank for payment. Right? And the payment will receive. Now we read the first paragraph now. What the first paragraph says? Your valid customer Silva has secured export order to a buyer in Italy for the supply of goods 120 days DA terms. So from here, it takes 120 days to realize the proceeds from Italy. Right? 120 days means 4 months. 4 months. From here is 4 months. What do you get here? Export proceeds, that is realized export proceeds will receive in here after 4 months and hit the bank's nostro account. So bank will debit the nostro account and credit the customer account. Before that, bank will receive what you call recover the loans. Right. So this is the timeline. If you can manage this timeline, you are through. Not a difficult thing. Right? This is the timeline. Right. You are required to structure a package of financial facilities for the purpose of serving this order and indicating the basis on which the revolving credit limit for each facility was computed. The facility shall be made available in Sri Lanka rupees assuming the rate of exchange is €1 is 160 LKR. Right. Now here there's a use and LC. So to kick off with the LC, customer should have a user's facility. Customer, just a walking customer cannot give a LC application and tell the bank, here this is my LC, send the LC off. No. This system will not accept as an input. There should be a limit earmarked in the system for me to accommodate that customer's transaction. So that's the limit that we are going to structure to earmark in the system. Right. So I will take a T account. This only for explaining purposes. You can take it down. Only for explaining purposes. This is. So I will just say LC. And I will just say U here because it's a user's LC. 90 days. Before doing that, to make things easy, with the assumption of 4 weeks equal to 1 month, we'll name the months here. We'll say this is January. So 4 weeks from January, this is February. Then 4 weeks from here is March. So you needn't say, because you get 4 here, you need not say 1st January or 1st February. But if it's a half a month, then you have to say 15th February. Right? January, February, March. 4 months from March is April, May, June, July. Then 4 months from July is November. Right? Now here say January, let's say outstanding. You open a €80,000 LC in January. February also customer bill open. March also customer bill open. June, July, August, September, October, November, indefinitely customer bill open periodically, but the period monthly LC will be open. So you can jot down indefinitely. Now see, when the documents come in March, and there's another assumption now here. There's one guy who is working for imports, so he will wonder. We assume there are no partial shipments. If you open the LC for 80,000, even though the customer says partial shipment, when we structure the limit, we structure for the full consignment. So we assume that the documents are coming for the full value of the LC. Right. This is for the comfort of the guy who is working for imports. Right. So when the documents come for €80,000, now I need to tell you all a small concept. Only for this sum, it will apply for every sum. That is, when you open a LC, you credit LC open account for €80, equivalent in rupees. It's a revaluation account in rupees, and you debit LC outstanding account. Now this is the LC outstanding account that I took it. That's why it's a debit balance in here. These are called contra entries. The other day I told you this. The mirror image of this. This is a credit plus entry. This is a minus entry. This contract will be passed by the banker in the import division no sooner the LCB is open. Nowadays, guys will not know what the double entries are, because when you input the LC application to the system, at the back end, this entry will get passed. There are no manual entries involved. This is the double entry for globally when you open letters of credit, what happens in the back end. Right. So the one leg of the transaction I took it this for explaining purposes. This contract we will get now. This is a contingent liability. Contingent liability. What's the contingent liability? Event may happen, may not happen. Just because the customer has opened the LC, bank needn't worry because bank doesn't have warm seat because it's not a direct liability. It's an indirect liability. Because once we open the letter of credit, until the documents come, we will not know the LC is workable. LC is in force all right, but the bank needn't pay if the documents won't come. So it becomes a direct liability towards the bank only on the receipt of documents, not at the time the bank has issued the letter of credit. So therefore, if LC outstanding is an off-balance sheet item. If there are any senior guys, senior bankers in here, go to the P&L account, the balance sheet of a bank, and see whether LC outstanding is there, it's not there. Because it's an off-balance sheet item. Risk is only 20%. That is 1/5 of the contract value. Right? But when the documents come, what happens? Now bank has an exposure. Bank has to pay for the documents if the documents are compliant. Documents are compliant means if the documents are in order according to the letter of credit, bank has to pay despite the fact that the buyer do not pay even. Basically, LC is a guarantee given by the issuing bank towards its beneficiary. So if the beneficiary performs with good set of documents, the issuing bank has to pay, not shall pay, has to pay. That means it's a direct charge towards the bank. That means when the documents comes in March, now this happens in January, when the documents comes in March, what happens? Bank has to pay. When the bank has to pay, there's another liability it creates. It's a direct liability now, it goes to the balance sheet. It's a direct liability. For one transaction, you can't have two liabilities. Indirect liability and direct liability. So therefore, this liability, this indirect liability converts into a direct liability when the documents come to the bank. How you convert? This entry gets reversed. So we have the no sooner this bill is get registered in the what you call in the system, this contract that you passed initially get reversed. Get reversed. So when you get reversed, what happens? Now here, according to my example, there are 380s here. 380s. When the document comes for 180, this outstanding gets reversed. 180 will get reversed. Right? Did not understand? I will tell again. Now, this happens in January. Right? So LC outstanding is 80. February also he opens LC is 80. March also he opens LC 80. Now what is the LC outstanding? 80 to 3 times. That is 240. Right? So when the documents comes in March, LC outstanding should get depleted. I told you the contract will get reversed. So in March, this LC outstanding gets credited by 80. Now you see the depletion. Right? And goes in where? Goes to the bill account. It goes to the bill account. Now we don't have an indirect liability, now we have a direct liability. Now we have another T account now, the bill outstanding. Bill outstanding. Users bill outstanding. Right? That reflects in here March 80. For this bill outstanding, since it's a user's bill outstanding, you call this as an acceptance facility. Acceptance account. Acceptance account. Right? Now you see 80, 80, 80, March 80. Right? So this March and this March goes off. So outstanding is 2. When the LC will open in February, what happens? Documents comes in April. April. That will go with the April LC. This will go with the April LC. And March will go with March. So again, there will be 2 outstanding. So any given time, even though the customer says periodically, indicating that he's going to open LCs $80, 80 euros for monthly terms, bank will not give him a facility more than twice of 80 euros. So the maximum limit that bank will fix for him as a user-specific facility will be twice of 8,000 at the rate of 160 in rupees. That is 106,000. That is 25.6 million healthcare. Understood? Right. If you understood, at least tell me, except for the guy who is working for imports, any other guy, just tell me yes up to this point. Now, Gerald, you are not working for imports, right? No. Okay, okay. Right. So, now we take down the base of calculation. At the first use at the glance, could be a bit difficult, even for the guys who are working for imports, no wonder. But I'll make sure that it's very, very comfortable at the end of the session, perhaps how to put this session from now, right? Don't worry. So, take the base of calculation. LC, users LC facility. That's the caption. Users LC facility. Users LC facility. Say John, not John Limited, who's the customer Silva, right? To import raw material, import raw material, simple RM, import RM. To import RM, Silva Limited will have to open an usance LC. Will have to open an usance LC for euro 80,000. For euro 80,000. This LC will have to be open 4 weeks prior to the shipment date. This LC will have to be open 4 weeks prior to the shipment date. It will take further 4 weeks to receive the goods and documents. It will take further 4 weeks to receive the goods and documents. Therefore, this LC will be outstanding for 8 weeks. Therefore, this LC will be outstanding for 8 weeks. Right. So that's your base of calculation. Will attract 1 or 2 marks. Very likely it's 1 mark, right? Then underneath, that's the calculation. You get 2 marks for this. So all in all, for one facility, you get 3 marks. Therefore, revolving users facility. Therefore, revolving users facility. Users facility is equal to LCAR 80,000 into 2 at the rate of 160, that is converted rate being given underneath, is equal to 25.6. If you do not know the 16 times, then you can use a calculator. Otherwise, it's 25.6. What is the revolving? Revolving means you have a higher point and a repeated point, right? You started with 80, 80, 80. Documents came, it went down, depleted, right? Now the bank can accommodate another LC because 80,000 came and went. So it depleted again, and when the LC comes in March, it resurrects again or inflates again. So it's a revolving facility. That's what you call a document liquidity is a self-liquidator, unlike in other products, right? So is revolving facility should be revolving LC. Users LC facility is LKR 2 into 80,000 at the rate of 125.6. So that's all. That's one answer, right? Now in March, documents came, right? Documents came, and I created an account called a bill account, users bill account. For the users bill account, you term as the acceptors account. The bill outstanding is called the acceptors account. Acceptors account. So when the documents come, and if the document is a user's document, bank will accept the bill of exchange from the customer and release the documents without payment. Customer has to make the payment on the due date. So since the bank is giving the authority for him to go and clear the cargo, bank faces the risk that the customer might not show up at the date of maturity. It's under LC, remember. So therefore, bank will grip the customer by earmarking another limit called an acceptors limit. So that is why we need to have acceptors account. Right. So March 8,000. So likewise, you find in April another bill coming in 80. LC which open in February, documents will come in April. LC will open in March, documents come in May. Right. So when the acceptance account will get mature, 90 days from the date of shipment. 9 days from the date of shipment. You have to read the question properly. It's 9 days from the date of shipment. Not the 9 days from the date of receipt of documents, not from the shipment date. Shipment date is February. So 3 months from February is March, April, May. So May, this acceptance account will get null for the particular one transaction. That is for the March document, it gets matured in May. How did it mature in May? 90 days being calculated not from the date of receipt, but from the date of shipment. Why is that? Because the 10 is given as 90 days shipment, the LC. Remember, if the LC is 90 days shipment, the documents also have to come 90 days shipment. That goes without saying, right? The same tenor. Understood? So March document ends in May. Then April documents ends in June. May documents ends in August. July. Right? Period in here to here is only 60 days, not 90 days. It's 60 days. Why? 1 month being taken off the gap between the shipment date and the receipt date. So even though the customer has given, customer has given the supplier's credit of 90 days, effectively the buyer gets only 60 days, right? Right. One more thing you need to remember, this acceptance account, now this particular point after I tell you, you have to take on the footnote, right? This acceptance account is a must that you need to create if the LC is an user's LC. Acceptance account is a must if there's a user's facility. If the LC is a site LC, acceptance account is not there. That's nothing to accept. No, if it is site where the documents come, it's been demanded. If the documents are received on this particular day, and if the documents are compliant, you demand the payment. There's no question of keeping the documents. So acceptance account is not there. Okay. Right. So that little line has to be put in the base of calculation which attract additional 1 mark. Right. Now the second facility is acceptance facility. Acceptance facility. Since the LC is an user's LC, since the LC is an user's LC, user's LC, bank has to grant an acceptance facility. Bank has to grant an acceptance facility. There are the acceptance is capital A, capital A. Grant an acceptance facility. That for that sentence, examiner will give 1 mark. In his marking paper, he being guided to give 1 mark for that particular sentence. So assist him by writing that without fail. Bank has to grant an acceptance account. Say, documents and goods received. Documents and goods received. One month after the date of shipment. 1 month after the date of shipment. 1 month after the date of shipment. Tenor of the LC, TENOR, tenor of the LC is 90 days from the date of shipment. 90 days from the date of shipment. Therefore, user's bill will fall due for payment. User's bill will fall due for payment. "60 days from the date of receipt of documents." 60 days from the date of receipt of documents. Right. Look at the board now. Now we'll see the outstanding levels in here. In any given time, in end of March is 80. End of April, twice of 80. End of May, this May and May will go twice of 80 again. End of April, again is twice of 80. End of May, end of June, this June and this will go off. May and May will go off, and twice of 80. So the maximum acceptance facility is like the LC outstanding, that is twice 8,000 at the rate of 160. Understand? Right. Therefore, bank has to grant an acceptance facility at least for 2 months. At least for 2 months. At least for 2 months. So underneath that's the base of calculation, you get 2 marks for that. And underneath you say therefore, if acceptance facility is equal to LKR 2 into 8,000 at the rate of 160 equal to LKR 25.6 million. Now you need to custom yourself how to write a base of calculation. I took assistance of writing the base of calculation, telling you the base of calculation, looking at the timeline and also the what you call the T account of the worksheet. Right? But I didn't say January, February, March and kind of thing. I didn't say. This I used for me to explain to you. And you also use this to explain to yourself. The examiner is not worried about your timeline or this. He don't worry. He's worried only about the base of calculation. But you can't just figure out the base of calculation without the timeline and the T account. But if you master the art, of course, you can get it off with this. Right? But I expect you all to do this thing because it's perfectly 100% right. Accuracy will be maintained if you put the what you call the T accounts as well. And one more thing, these are not academic exams; these are professional exams. So your marks will not get cut for manipulation or some untimed presentation. Therefore, in the answer script itself, you can show the timeline and the calculation part. No harm. But it will not be regarded by the examiner. You will not get marks for this. Underneath, you write the base of calculation. Right? So you keep a space in the front sheet or the first paper to write all the cut header there, all the T accounts. In between the base of calculation and the calculation, don't creep the what you call the T accounts. You put it one sheet of paper. Looking at this custom, what you call the paper marker will not bother that much to read the base of calculation. He will know that you have the knowledge, the basic knowledge of structuring limits, and he will give marks. Right. So this is the acceptance account and this is the outstanding. Right. Now have a little bit of concentration. I will tell you, March documents came, that particular document matured in matured in May, right? 6 days from the date of receipt, 9 days from the date of ship. It matures in May. So April, May, 60 days. Right? So to credit the acceptance account, you have to debit something. Right? The ideal situation, you have to debit a customer's account. Customer's account. What happens if the customer will not have money at the time that the bill gets matures? Then this cycle will end in here. February LC will not be open to the customer. So therefore, the bank should be prepared in the first outset itself to finance him an import loan if he doesn't retire the import bill, that it will settle the import bill out of his own funds. So bank has to think of a short-term import loan. Short-term import loan. Not a short-term loan, it has to be an import loan. Short-term import loan. Right? So we have to have a short-term import loan now. Right? And when the loan account will get debited? In May. In May. June, July, August, September, October, loan account will keep on debiting. Does it mean that the bank has to, what do you call, grant import loans indefinitely? We have to see that, right? Now the bank has given a loan, short-term loan. When the bank gives a short-term loan, bank has to calculate and see when the loan getting what ready. Now see, look at the timeline. Document received in March, and it takes 4 months to manufacture and export them. That's in July, the document, but the goods will get exported, and July, exported documents will be given for purchase, and in July, customer's account get credited. In other words, bank will create funds of all export will purchase proceeds will come in July. So here in July, you say you're not worried about the amount actually. This is not an accounting thing, no. You just want to know the idea of accounting only. So July export bill proceeds will come. Back of your mind to make yourself comfortable. If you are a trade guy, just think that the export bill proceeds is more higher than the import AC. Right. In July it will come. So until July, bank has to keep on granting loans. Where bank has to grant because the proceeds will come on in July, no? And June bank has to grant 80,000 twice once again 25.6 million. So the bank has to earmark usance facility for 25.6 million, acceptance facility for 25.6 million, and a short-term loan also for 25.6 million. Otherwise, this cycle will not lead. Cycle will not lead. Right. Now you take down the next facility, short-term import loan. Short-term import loan. Short-term import loan for the purpose of in the caption itself, right? You have to say why you are giving a loan for the purpose of you see if I write in here for the purpose of retiring. If the retiring is too much of a word, you can say settle. For the purpose of retiring, users import bill. For the purpose of retiring, users import bill. Right. Now write the base of calculation. Bank will receive the users import bill. I'll come again. Bank will receive the users import bill. Bank will receive the users import bill one month after the shipment date. 1 month after the shipment date. And it will mature. And it will mature. In other words, fall due for payment, right? It will mature. It will mature. 2 months after the receipt of documents. 2 months after the receipt of documents. Two months after the receipt of documents. However, bank will purchase export bills. Bank will purchase export bills four months after the date of receipt of documents. 4 months after the date of receipt of documents. Right. Turn off a little bit. I'm trying to explain it different way now. Now see, bank will receive documents 1 month after shipment date. Fine. That's what indicates its timeline. And this document will fall due for payment 2 months from here. 3 months from February, 2 months from here. 2 months. But the proceeds will come only after 4 months. Bank will purchase export bills after receiving the documents 4 months. Time taken to manufacture goods and export them will take 4 months. So for this gap 2 months, bank has to bridge it. Otherwise, the chain will break off. That is why we give the customer a short-term loan. That's what I'm trying to explain in the base of calculation. Right? Understood? Right. Now, it's 40 for payment, 2 months for this thing, but however, bank will purchase export bills 4 months after the date of receipt of document. Up to that point, you have taken down. Therefore, bank will have to grant short-term import loans at least for 2 import shipments. At least for 2 import shipments. At least for 2 import shipments. Right? Underneath, short-term import loan facility, that is SIL. SIL. If you say SIL, it's an acceptable abbreviation for short-term import loan. Right? SIL. Facility for this purpose is equal to healthcare 80,000 into 2 at the rate of 160 equal healthcare 25.6. Right. In the month of July, banks start to purchase export bills. To purchase export bills, the customer has to have a purchase facility. Even to purchase a check, the customer should have a check purchase facility. Likewise, to purchase export bill at requirement, customer should have an export bill purchasing facility. Right? So we check the export bill purchase account now. July, bank will purchase export bill. Now you don't do a mistake in here. It's a common mistake the students commit. You have to put the correct amount. Look at the first, what you call the paragraph of the sum. It's not 80,000, 80,000 in the import receipt. Export bill is euro 100,000. 100,000. So you will not forget here. If you put €100 here. Then you will not forget. €100 is the timeline. So the purchase amount is 100,000 when you are purchasing first in July. Why? Export purchases are purchased in July. You got a timeline. Second one will be in August. Right? Next one will be in September. Other one will be in October. November bank will not purchase. Why? The proceeds, the export bill, purchase export bill will get realized after 4 months because 120 days DA, it says tenor. So in November, that will come and hit the nostro account. So until November, bank has to keep on purchasing export bills. In November, what happens? When you are going to balance this, we'll say export bill purchase, what do you call export bill proceeds will come. After purchase, proceeds will come. Right? That means it's 400,000 into 4 at the rate of 160. That is LKR. 16 times 4 is 64 million. Right. So we'll take down that also. Export bill purchase facility. That's the next facility. Export bill purchase facility. Export bill purchasing facility. 5 minutes to go. Double up a little bit. Export bill purchasing facility. Tenor of the export bill. Tenor of the export bill. Is 120 DA terms. Tenor of the export bill is 120 DA terms. Value of the export bill is €100,000. Therefore, the bank have to. Purchase at least 4 export bills. At least 4 export bills. Towards this customer. Towards this customer. Towards this customer. You need not say after the 4th month it will come and hit the nostro account and all. You needn't say. Right. Therefore, export bill purchasing facility. Therefore, that is underneath. Therefore, export bill purchasing facility is equal to LKR 100,000 into 4 at the rate of 160 equal to LKR 64 million. Equal to 54 million. Equal to 64 million. Right. The 2 is there, so I need to finish this off. If I take an, usually I don't do, if I take an extra 1 minute, you have to bear up a little bit. And I want you all to not to read a particular sentence. Now I'm going to do that is off the queue. In other words, off the timeline. Now we'll read that now. The credit charges and custom duty for each shipment is 5,000 and will have to be paid on arrival of goods. The overhead expenses, wages, etc. will be met using their own funds. So clearing charges. Clearing charges in sense when you clear for imports, for every importation, when you clear from the customs, you have to pay import duty. And that is for one single shipment is euro 5,000. So you have to count from the timeline how many shipments are there until the proceeds comes in July, not in November, but in July. Why? You are creating money in July by purchasing export bills. So from March to July, that is March, you have to count March also, because March has a clearance. March, April, May, June, 4 months. And July, prices are coming. So 4 months. So you have to create another short-term loan. You don't create an import loan for clearing duty. Short-term loan. And if you are a good fund manager, you can give an overdraft also as well. Short-term loan for this purpose. So take it on quickly. Next facility, short-term loan. It's time up now. I'm taking your time. Short-term loan. For the purpose of clearing charges and custom duty. For the purpose of clearing charges and customs duty. Say, time taken to manufacture. Time taken to manufacture. Time taken to manufacture. And receive the export bill purchase proceeds. And receive the export bill purchase proceeds. Will take 4 months. Will take 4 months from the date of receipt of documents. Will take 4 months from the date of receipt of documents. Therefore, there are 4 clearances. Therefore, there are 4 clearances. That's obvious, right? 4 clearances. Every month there are clearance. 4 clearances. For since 5,000 euros is the charge per shipment clearance. Bank has to grant short-term loan for 4 import shipments. For 4 import shipments. That is LKR 5,000 into 4 at the rate of 160. LKR 3.2 million. Right. So we'll wind up now. I took half a minute from your rather 2 minutes, 1.5 minutes. Just make a note saying that you understood so that I could do some homework and come for the second one. Second sum is a very good sum. It's a bit of a complicated one. And with the forex sum, I will do the next session. If time permits, I will do a URC one also as well. Just give me a nudge quick as possible so that you will review me before I go. Whether you understood or not, just say yes or no. If you say no, of course I can't do anything now, but then I will do some homework and come to simplify and do the sum again. If you say yes, I can go for the second sum. Understood, sir? That is Pradeep. No, you should tell somebody else. Vishwa. Yes, thank you. Understood, right. Thank you so much. Thank you, Gerald.